Are you using your 401k the wrong way? You're going to watch this.
It's Brian Preston, the money guy.
So, Brian, this is what I think is going to be beautiful about this show. I feel like we have a duty to the financial world. There's been so much bad press out there. So many folks saying, oh, 401ks aren't good anymore, or maybe you shouldn't be using them, or it's an old, antiquated thing. And we know that folks who think that way really don't understand just how powerful this tool in your financial tool belt can be.
Well, it's definitely something that I think if you don't understand how this works, how can you harness the power of growing this towards financial independence if you let all these misconceptions, if you let the negative stuff seep in, you'll never get the maximum benefit. So that's what we're going to go deep dive here, guys. We're going to try to both keep me honest. Don't let me get sidetracked on some, going down a tangent that I don't need to be.
There's no way.
I want to make sure we keep this moving today.
There's no way that I could do that. No way can I actually keep you from that. But I do think it's interesting because we're going to walk through the basics, where they came from, how they work, how they operate, things you need to be careful for. We're going to talk about some basic strategies. Then we're going to close out talking about some advanced strategies. So this is going to be everything 401k today.
Yeah, instead of reading 4 or 5 different blog posts or watching 4 or 5 different YouTube videos, this is going to be your source.
Love it.
So let's jump in. First, where did these things come from? How did we even get 401ks?
So we thought we'd put together a little timeline for you. And if we go back to 1978, Section 401k was added to the IRC, allowing employees to avoid taxation on deferred compensation. So if they wanted to move some of their income into the future, they wouldn't have to pay tax on it present day.
Were you excited when they passed that legislation?
I was super stunned. 78 was a good year for Bo Hansen. Was really excited about that.
So that is, it is interesting. So it has allowed employees to avoid taxation on deferring the income to the future years, but that didn't really change anything. What actually opened this up in 1981?
Yeah, in 1981, the IRS started allowing employees to fund 401ks through payroll deductions. So now, rather than deferring compensation, they could actually say, you know what? I want to take a little bit of my paycheck and have it go into my 401k account each pay period.
So 1978, building block 1981 is where they actually lit the firecracker, and then that's when this thing started building assets. And how successful have 401ks become in building assets?
It's been pretty remarkable. In 2020, 401k plans now hold more than $5.6 trillion in assets. That's really a 40-year period that it's gone from zero to $5.6 trillion.
So I always think it's important. So for these things to catch on, there has to be a why. Why did employers, because let's face it, pre-1980, defined benefit pensions were kind of what was going on out there. And look, this is not, I don't want to paint this all cherries, all unicorns and rainbows, that 401ks are all great news, because it was, it fell upon your employers to ensure that you came and you worked at a job, and then they loaded up your retirement plan. You participated as well. But then when you retired, that's why they're called defined benefit. They guaranteed the benefits you would receive at retirement. Well, as you can imagine, population's growing. Companies are starting to realize, hey, employees are starting to, it's not like you take a job in 1970 and you work for the 30 or 40 years. Employees are starting to bounce around a little bit. So they came up with this alternative, and this is known as defined contribution. Break out the difference, Bo.
Yeah, the big thing is defined benefit plans, the risk rests on the employer. They have to make sure that there's a retirement benefit that exists for their employee for the remainder of their life. With a defined contribution, the risk actually falls on you, the participant. If you want to have retirement assets, you are the one that are responsible for saving those assets to get to retirement, and then in retirement, managing those assets for your benefit. It was a big risk shift from employers to employees.
So that's what I think is interesting, because I asked Daniel, I said, Daniel, when we're putting together the slides, here's what I need. I want to know how many plans existed like in 1980, 1981 on the defined benefit, and then I want you to compare and contrast what has been the change over the last decades. And he did a great job. By the way, he did this in a way because we didn't want to throw the numbers off by including companies that were less than 100. He did only larger companies, so 100 employees or greater, and the numbers are pretty striking.
Yeah, so this is directly from the Department of Labor from 1975 all the way through the end of 2017. And you can see in 1975, there were a little over 20,000 defined benefit or pension plans. Well, fast forward to 2017, there are only about 8,000 pension plans available to employers with more than 100 employees. Contrast that to, in 1975, there are a little over 8,500 defined contribution plans. Now there are over 82,000 defined contributions. So there's been a huge shift in how employees save for and prepare for retirement.
By the way, okay, here's one of those tangents I can't help but go through when I see
those
data.
things you asked me to not let you do,
Okay.
you're about to do? Okay.
Notice right between, in the late 70s, there were 20,000 defined benefit plans, right? Now, we know, as of 2015, when this data was published, that's cut by half, a little more than half because
sure.
it's at 8,000. So like, wow, okay, so we did drop 60% of the plans. But here's what I think is interesting. There are
82,500
defined contribution or 401k plans for 100 or greater employees. This is why when I talk about the ever-expanding pizza pie of the economy, this is it, guys. There's just more employers that have over 100 employees. That's a positive thing for economies. I think when innovation is growing and all these good things, when people say, well, the markets keep going up, I'm like, yes, because when we look at this 20 or 30 years from now, there's going to be 130,000 plans out there because the economy will keep growing. Okay, that's the end of my sidebar. It's just that I get excited when I see that the economy does grow. It's not a zero sum where somebody loses so somebody else can win. We are growing this thing forward.
And so it sounds like, folks who are working, folks who are building financial success have recognized that 401ks are a great vehicle to do that. If you look at the Ramsey Solutions National Study of Millionaires, 80% of millionaires acknowledge that they invested in their company's 401k plan. And most folks, when they reached millionaire status, they did so around their late 40s inside of their 401k plan. That's where they reached their millionaire status.
And that makes sense because if you think about what is probably one of the best ways and one of the habits or characteristics of what I see in millionaires, and what it is systematic, forced, and continuous savings.
That's exactly right.
And what do you know what a 401k does? It allows you to systematize the savings, and it doesn't matter good news, bad news, that volatility that you face because of a pandemic or whatever's going on with a global recession. With a 401k, if you do it right, you set it, forget it, and you're buying the entire process. It is that type of process that leads to, by the time you're 49, you wake up one day and go, wow, all that money I saved has truly turned into an army of dollar bills.
So the natural question you're probably asked is, okay, I'm sold. You've told me that I ought to be doing this 401k thing. I'm in. I want to be a part of it. All right, walk me through now. How do they work?
Yep.
What's the simple gist of how a 401k plan works?
So let's talk about the first thing is you're going to want to know, and you saw this was the legislation that passed in 1978, but then really was lit in 1981, is that you get to put money in. That's the first thing. You put money into the retirement plan.
Yep.
And then that money grows either tax deferred or tax free if you put it in as a Roth type investment.
And so what that means is while you put the money into the plan, you're able to invest it. And every year, as the account goes up in value, as the investments grow, you don't pay any tax on that. But when you get to retirement and you start pulling that money out, you take it out, that's when you have to pay tax if you built it up in the pre-tax portion. Just like you said with a Roth, it also grows tax deferred, except for when you pull it out, then you actually didn't defer to taxes. It's completely tax-free.
And when will you actually pull the money out? If you keep the money in a qualified plan, like the 401ks, 457s, 403bs, you can pull it out at 55 if you've separated service, or if it's in an IRA at 59 and a half, you have access to these assets. So you can see the whole, it's kind of like this big money machine. You put the money in, you kind of give it enough time to let it grow, let your compounding interest kick in, and then in the future, you're pulling that money out for retirement.
So we just talked about, Brian, how, all right, you put money in, and it can either grow tax-free or tax-deferred. So it sounds like there's a choice in there. Do I want to put it in on a pre-tax basis or a tax-free basis, well, the next question that most people are probably going to ask is, how do I know? Should I do Roth or should I do traditional? How do I know what's best for me as a 401k participant?
And these are unique times to kind of think about this, because I always say it really depends. Depends on several factors.
Sure.
And we're going to go through those. I'm just going to give a few overview things, and then I want you to kind of go through each one. I think your age is going to have an impact on this.
Yep.
How far do you have from retirement? Because we know the younger you are, the more powerful your army of dollar bills. We also know, what is your outlook? I mean, these are unique times. Yes, tax rates have actually come down because of the legislation that got passed at the end of 2017 that for the tax year starting 2018. But we know there's a lot of political discussion about taxes going back up. So all these things come into play. So, Bo, kind of bundle that all up and tell people what are the decision points they need to consider.
Yeah, so basically, if you're thinking about should I choose traditional, should I choose Roth, we think choose traditional if you expect to be in a lower tax bracket in retirement. So perhaps right now you're a high income earner, you're in the higher tax brackets, and you think that when you get to retirement, taxes will be lower or your specific tax rate will be lower. It probably makes sense to build assets in a pre-tax fashion. Or if you're someone who thinks later on, I want to do some sort of in-plan Roth conversions where I actually pay the tax and convert traditional pre-tax assets into Roth, then you might want to choose traditional. Those are kind of the two times that we think traditional makes sense.
I also think I'd throw in there, if you're somebody who thinks you're going to retire like 55, even 60-ish, you know, part of the FIRE movement, and you are going to go from a much higher tax bracket to where your income is going to get cut way off. You might be able to manipulate through Roth conversions or other things. That fits into the kind of that second component on why you'd want traditional.
So then if you're trying to figure out when should you choose Roth, well, choose Roth if you expect to be in a higher tax bracket in retirement. Either perhaps now you're in a low tax bracket, but you know as your career changes and your lifestyle changes, when you go to pull the money out, taxes will be higher. Or perhaps you think that legislatively taxes will be higher at some point in the future when you retire. Roth is probably going to be a better solution for you. Or, and this is exactly what you alluded to start with, Brian, if you're young and you expect that your income will increase and your lifestyle will increase, Roth might be a really great option for you. And then lastly, if you are getting closer to retirement, thinking about when you want to start distributing your assets, if you want to minimize the potential tax impact on your Social Security or your Medicare Part B premiums, you may want to build assets in Roth because when you take those distributions, they won't affect Social Security and Medicare premiums.
So, Bo, I got to tell you, that at the end of that, it starts going wah, 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 wah. It turns into Charlie Brown. We have some visual learners, I'm sure, that want an example. Can you kind of walk through traditional versus Roth? What are we talking about if you actually did an example with real numbers?
Yeah, so we think that case studies are always the easiest way to learn. So we're going to lay out Roth Ralph, and pre-tax Patty. Thank you, full-time equivalent Daniel, for those names. Ralph is going to invest in the Roth 401k, and Patty is going to invest in the traditional 401k, and then she's going to invest her tax savings. Because remember, if we put in money in the traditional, we have some tax savings. We're going to assume that she invests that. So let's assume that each of our two participants are 22 years old, and they're going to retire at age 65. Let's also assume that right now they both make $40,000 per year and they listen to the Money Guy show, so they're going to save 20% of their gross income or $8,000 into the 401k. Let's assume that their salaries grow at 3%, and let's assume that their invested assets, whether it's in the pre-tax or Roth, are going to grow at about 8% annualized over their working career. We know that right now they're both in the 22% marginal tax bracket, but because their income is going up and because their income will be higher later on, let's assume that in retirement they're going to be in the 24% marginal tax bracket. And because we know that Patty is going to be investing in an after-tax account, let's just assume that the tax on any capital gains that she generates is 15%.
Now, we're going to go through the actual numbers, but I think there's some key things here. If I was kind of like reading Rainbow style, highlighting the things that I think people ought to pay attention to. Both of these individuals are young, 22 years of age, letting their monies grow until they reach age 65. That's a clue.
Huge.
The other part I think is interesting is that we have a big assumption here is that they're currently in the 22% marginal tax bracket, pretty reasonable. But we think because of maybe future income sources, pay raises, or maybe they even have, some other income streams like rental property or something that's going to push them up into retirement into a higher tax bracket. So they think when they retire, taxes will actually go up.
Yep.
That's another clue of something they ought to consider. So go ahead and play out the numbers.
So if we just look at the 401ks, remember both of them are putting $8,000 in, and then that's going to grow each year. So on the surface, inside of the 401ks, Roth Ralph has about $4.4 million by the time he gets to retirement. And pre-tax Patty also has about $4.4 million by the time she gets to retirement. We're just looking at the 401k balances.
Wait a minute. Those numbers are the exact same.
Same.
But wait a minute. There's more to this because one is after-tax contributions and one is pre-tax, meaning you get a deduction when you make the contribution. How did we make up for that?
So let's remember that pre-tax Patty gets a tax benefit. Every time she puts her money in, she saves a little bit, and we're going to have her invest that. So in addition to her $4.4 million pre-tax 401k, she's also going to have an after-tax brokerage account that's going to have about $764,000 in there. Now, we know that in after-tax accounts, the money doesn't grow tax-deferred. It gets taxed annually. So we just said, let's assume that account grows at 7% per year instead of 8%.
Okay. So you put a 1% kind of a tax
drag
headwind to it.
Yep.
Okay. That makes sense.
So what actually happens is at retirement at age 65, Ralph has about $4.4 million, but Patty actually has about $5.2 million.
So if we stopped right there, we'd be like, it looks like taking the tax deduction actually was a good thing, especially if you were disciplined enough to put the money to work. But you're like, wait a minute, there's more to this, isn't there?
There's more. Remember, Ralph has all his money in Roth. So when it comes out, it's completely tax-free. Patty does not have that luxury. So if we assign a 15% capital gains rate to the earnings in her after-tax account and a 24% marginal tax rate to her pre-tax account, we see that her total available balance, purchasing power balance of her assets is only about $4.1 million, while Ralph's is still $4.4 million. So in this scenario, two identical savers, it was actually more advantageous for Ralph to build assets in the Roth tax-free than for Patty to build assets pre-tax and save the tax savings each year.
So just kind of summarizing, the $765,000 of after-tax money, once you took into account like a 15% capital gains tax rate just on the earnings, not on all the contributions, went down to $741,000. The 4.4, close to 4.5 million that was in the pre-tax, as soon as you took your 24%, because remember taxes went up in retirement, that's what brought it down to the 3.4. Bring those two together, that's where we came up with the 4.1. Now, let me ask you, I just want to play the other side, devil's advocate.
Sure.
Because you said it right. Ralph would have been more advantageous because we assumed that taxes were going to go up in retirement. Plus, he was young, so you had a lot of growth here, compounding interest. If we would have flipped the script and maybe changed the tax rate from 22%, but it went down to a 15%. We just made a guesstimate of what rates might be in retirement. This would have probably gone the other way.
It would have gone completely the other way. Pre-tax Patty would have had more money. Now, let's pause for a second. And we talked about this a little bit in pre-show prep, Brian. Realistically, it's not this static when it comes to saving money. What often happens is while we're young and we have lower incomes, we save in the Roth. And then as our income gets higher and the tax benefit becomes more valuable, we might start saving in pre-tax and taking advantage of the current tax benefit. And then as we age and our tax planning changes, we might go back to the Roth, or perhaps we split. Very likely you won't stay in one bucket for your entire working career. And that's what makes this part science, part math, but also part art.
That's great, though. Good job, FT, Daniel, also in helping us put this illustration together. And that does lead to, because I think we have to understand, because we just alluded to, there are really two participants in this retirement plan. There is you, the employee, and your contributions. And then there is your employer and their contributions. But let's talk about when you, the employee, put money in, you have essentially, it sounds like 2 pots, but we know, because we get bonus credit points here, there's actually 3 pots that you're putting into. Walk through those 3 different areas.
So almost every plan, I'm going to say every single 401k plan will allow you to do pre-tax 401k contributions. So your contributions go in before tax, and then distributions are taxed. Well, a lot of plans, and this has changed over the last 10 to 15 years, now have a Roth option where your contributions go in after tax, and distributions are completely tax-free.
Now, there's something interesting about Roth 401ks, Roth 403bs, and 457s. I know Roth IRAs have income limits.
Yep.
As a married couple gets, right below $200,000, you kind of can't do traditional Roth contributions anymore. But Roth 401ks have 0 income limits. You can make $1 million a year and still contribute to a Roth 401k.
That's exactly right.
Another thing I think is interesting, if you are not over the income threshold for Roth IRAs, you can do Roth 401ks and Roth IRAs.
Exactly
so
right.
don't assume you have to just do one Roth. You can actually double up if you qualify for each individually. Now, something that's probably a lot of people is going to catch them off guard a little bit. They're like, wait, there's a third one there. What? After tax, what does that mean?
They're actually, for some plans, now not every plan offers this. You have to look to see if your specific plan does, but there's actually a third contribution option called after-tax 401k contributions. And what happens is your money goes in after tax. You don't get a deduction for it, but the earnings grow tax deferred. So it's different than the Roth, and it's different than the pre-tax. It kind of combines the two. So you put money in on an after-tax basis, and the earnings grow tax deferred. Well, what's beautiful about this is we know that when it comes to pre-tax and Roth contributions, there are contribution limits annually. It's $19,500 if you're under 50 right now, or $26,000 if you're over 50. What's really interesting is if your plan allows after-tax contributions, you're not capped at the $19,500 or the $26,000. You actually can put even more money than that into the 401k plan.
So this is a good setup, and maybe because I didn't see us put it directly here in the show notes, because maybe it's the advanced strategy.
It is.
But this is the setup for what we call the Mega Roth.
That's exactly
correct?
right. Yep.
So, but there's some cautionary tales, because we're teasing that we will come back later and give you in-depth details on how to do the Mega Roth conversion strategy.
Yep.
But there is something, because I've had this conversation with several people recently. First of all, you have to make sure if you do go beyond the $19,500 for those under 50, $26,000 for those 50 and over, that you don't crowd out your employer matching contributions and profit sharing.
That's exactly
because
right.
there is a limit. There's a $57,000 or $63,500 if you're 50 or over. That you have to make sure that you don't squeeze all that out with contributions on your side, that you don't leave enough room to get that employer free money too.
Exactly. You could be walking away from free money if you don't leave room for that. So if you are going to participate in the after-tax portion of your 401k, you got to do some mathematics over the course of the year to make sure that you're funding at an appropriate level.
Now, I've also, because there's going to be a lot of business owners and others who are going to get super excited about this, because we've even checked that box a few times. You also need to be very careful that you don't trigger any of the testing things, because there is, when you fund the additional after tax, it can trigger some of those highly compensated or top heavy type testing requirements as well, right?
Yep, that's exactly right. So if you're just a participant in the 401k plan and it allows after tax contributions, awesome, do it. Take advantage of it if it makes sense in your plan. If you're a business owner and you're thinking about adding this in, it might not all be sunshine and rainbows, because there are some additional tests that you have to pass. Just make sure you check 2, 3, 4 times before you implement this and add this to your plan.
That's a much better, instead of me trying to go through every one of the ifs, ands, or buts, on trying to figure out the planning, it gets complicated.
It gets complicated.
So that we also said is something there that I want to make sure we don't let just slip through. If you're 50, you get bonus points with these type of retirement accounts, because think about this. IRAs, because the government, I don't know if they feel bad, because I'm quickly approaching this age where you reach 50 and they're like, we need to give these guys, because it's probably about that age that if you have not understood how powerful your army of dollar bills, this is probably the age you're waking up one day and going, oh my goodness, I need to save for retirement. So the government's actually built into all the retirement savings vehicles an additional catch-up that you can save. And I want to give you perspective because they really have loaded it up when you talk about 401ks and 403bs specifically, because IRAs, as soon as you turn 50, you get an extra $1,000.
That's great. So in 2020, it goes from $6,000 contribution to $7,000 contribution.
Simple IRAs, they give you an additional $3,000 a year contribution.
So it gets a little bit better than just regular IRAs.
But as soon as you get into 401k territory, they give you an additional $6,500 a year.
Well, you can think very quickly. If you're someone that's in a higher marginal tax bracket, that $6,500, if you're making pre-tax contributions, can be some pretty material tax savings that was not available to your 49-year-old self.
So that's really powerful. We want to make sure we don't gloss over that because that's a powerful thing. But that leads to, because look, that's all the money you're putting in. That's that employee money.
Right.
Let's talk about the free money, or the money that your employer is giving you. Bo, walk them through how does that work and what are the components?
Yeah, so your employer can make the choice to put money into a 401k account on your behalf, which is awesome. They said, you know what, we're going to move away from the defined benefit. We're going to move away from the pension plan, but as a nod, we're going to put some contributions into the plan for you. And there's a few different types of contributions that they can make. The first and most common is called a safe harbor contribution. Well, the reason that employers offer this plan is just like we already mentioned, at the end of every year, 401k plans are required to do specific tests to make sure the plan does not disproportionately favor high income earners in the plan. Yeah. Well, what the IRS came out and said is, hey, if you give your employees a minimum contribution, a safe harbor contribution will allow you as owners or you as highly compensated employers to put more money in the plan so long as you're taking care of your people. Well, the great thing about safe harbor contributions is they are immediately vested as soon as the dollars go in. So just like the money you put into the plan is yours day one, safe harbor contributions are the exact same way.
And what I think is interesting, because we see these take the shape of, if your plan doesn't require participation, it's usually around 3%.
Sure.
If it's more of a matching type structure, it's going to typically require you to put in 4 or 5% to get that 4%.
Yep.
So that's because they're making it. And what's funny is that when you do these type of plans, that free money, we've told so many people, you do not want to miss out on that free money, that you're going to probably see pretty high participation. So usually you're going to see something, in the 3 to 4% range.
So safe harbor contributions are one type of money that the employer can put in. Another type of money is what's known as a matching contribution, where your employer says, if you put money into the plan, we'll put money in as well, but you got to have some skin in the game in order to do that. Well, depending on if it's a safe harbor matching contribution, it might be 100% vested, or if it's just a discretionary match where the employer says, you know what, if you put in 7%, we're going to put in 7%, or whatever the formula is. That's one other way that employers can put in money. And then the third way that an employer can put in money is what's known as profit sharing. Yep. And this isn't something where you necessarily have to have skin in the game. The employer says, you know what, this has been a good year, things are going well, I want to reward our people, so we're going to put profit sharing contributions into the plan. Well, the unique thing about discretionary matching contributions and profit-sharing contributions is often, because it is a fantastic benefit for employers to make available to you, they don't say, you know what, this is your money immediately. They want to put a little bit of golden handcuffs on you to make sure you stay around. They love you, they value you, they want you to have this benefit, but only if you stay with them, only if you keep doing that. So where safe harbor contributions are 100% immediately invested, matching or profit-sharing contributions might be subject to a vesting schedule. And there are really two types of main vesting schedules. The first is a cliff, where it says contributions are 100% vested after a certain period of time, usually like 3 years. So long as you've been at the employer for 3 years, all the money that the boss or that the employer puts in on your behalf is yours. You get to take it with you if you leave, retire, or whatever. Or they might have a graded schedule, where you get a certain percentage of vesting over a certain number of years. So the most often one we see is a 6-year schedule where it's 0% after 1 year and then 20, 40, 60, 80, 100 after 6 years.
I do want to make one distinction because I know we have a lot of our biggest group of YouTube YouTube viewers are actually that 25 to 34 range zone. And so that's the threshold where you're probably doing Roth contributions. And we get this question all the time where people say, I'm doing Roth, but my son of a gun employer is doing pre-tax. What's up with that?
Why would he put the money in the Roth?
You should put it in the Roth because that's what I chose. Here's why, guys. Your employer is going to take a deduction for that contribution. The way the government, just like they make you when you choose Roth contributions for yourself, they make you put that in with after-tax money because there's a promise in the future you get to let it grow tax-free and pull it out tax-free. They do kind of the same deal with your employers. Your employer is going to take the deduction now to give you that benefit. So that's why the money has to go in pre-tax. They didn't screw up. They're not doing you wrong. It's just kind of the way things are structured when you have employer money going into the plan.
So what that means practically is if you were Ralph or Patty who ended up with that $4.4 million 401k, there's a good chance that even though you did do Roth contributions, you'll have two different buckets of money. You'll have a tax-free bucket of money, but because the employer put money in on your behalf, you'll likely have some pre-tax dollars in there as well.
So let's talk about, because we've gone through vesting, we've gone through employee-employer matches, but there's a lot of you guys that maybe you have just started a company. We've gone through, I think, downturns in the economy are kind of like pruning a tree. And the fact that sometimes the economy takes a trim back and you see more businesses get spurred and started. And a lot of you guys might be, and you're also probably side hustling.
That's what I was going to say. I see this a lot with side hustles.
You've seen a lot of people that have all kind of income sources. So you might be thinking, how do I save for retirement? How do I do it well? Well, the government has tried to encourage, because traditional 401ks or those safe harbor 401ks or even some of the more complex ones, that's for people who have a lot of employees. There's actually a great shortcut. You could call it 401k with training wheels for small businesses or businesses that have started out with solo 401ks.
Yeah, if you've ever had a small business or you've ever had like 1099 income and you went to see your accountant, one of the things that accountants used to always say is, hey, a really great way to shield some of that money is you ought to open up a SEP IRA, which is great. A SEP IRA is a mechanism where you can put 20, 25% of whatever your business profit is into a retirement account and shield that from income tax. Well, what's beautiful about a solo 401k is it actually is a 401k plan, but here's what's unique about it. You get to be both the employee, the participant, and the employer. So we've already uncovered that there are two different types of people that put money into a 401k, the employee and the employer. If you have a solo 401k, you get to be both of those people. So not only can you do the employer contribution, you can also do salary deferral contributions up to $19,500. So it's a great way to likely save more into a retirement account than you would if you were just doing like a SEP IRA, for example.
Well, I think that's important because I don't want to trash SEPs because I love SEP IRAs too, because SEP IRAs are one of the few savings vehicles that if you get a client or somebody who's made more money, didn't plan ahead, a SEP can actually go back in time, meaning that you can go into last tax year, open up a SEP, even all the way up until October 15th of the following tax year, and get it in there. You can't do that necessarily with a solo 401k, but here is what's interesting. SEP IRAs are only funded by the employer, meaning that it's all, you could call it profit sharing, and it depending upon how your business is structured, it's probably going to be capped at 20 to 25% of your business income. You didn't get any salary deferrals whatsoever where you could do up to 100% of your compensation. Solo 401ks fix all of that. That's really the secret sauce, is because it's going to allow you to do what the SEP IRA does with the profit sharing, that 20 to 25% of the profit of the business, but it's also going to let you do that salary deferral, that $19,500, or if you're 50 or older, you get to stack another $6,500 on top of it. That is super powerful stuff.
But here's the catch. In order to have a solo 401k, you can't have any employees. You can have you and you can have your spouse or you can have a business partner, but as soon as you have full-time employees, you can't do a solo 401k anymore. You have to move to a traditional 401k type structure.
Well, and people like solo 401ks because you're probably like, well, why do I even want a solo versus a traditional? These things are very easy to administer.
Yep,
You don't have to
that's
follow
right.
what's called a 5500 initially. They exempt you out of a lot of the stuff because they know that this is a savings vehicle for a very small business with no employees.
Sure.
Or the only employees are the business owners and maybe the spouses of
That's
the
right.
of the business owner. But there is an issue with these things. Because remember, and this is something I want everybody listen and lean forward and kind of pay attention because I see this mistake all the time with small business owners. You started a company 7 years ago and you heard from a Money Guy show or some other source that solo 401ks were the bomb diggity.
Yep.
So you started
actual term we use.
you started saving and loading up your solo 401k and you love the fact that there's no filing requirements. It's all good. But this thing, it's like all things. They start building. Every year you're adding your contribution and it's growing. One day you wake up, your solo 401k is $300,000.
Should be a reason to celebrate, right? That's deferred gratification at its finest.
If you've done everything right, it's a moment to celebrate. However, if you haven't been filing the annual 5,500, because there is a threshold, the government gives you a lot of slack in the system with the understanding that if you ever get the plan over 250,000 in assets, you better start filing that annual 5,500. That's just a tax form that tells the IRS what's in your retirement plan. There's not even taxes due. It's more of just an informational
It's
return.
super easy. There's nothing complicated about it.
But they're not playing around. If you don't do this 5,500, but what are the penalties associated with this?
The penalty for failing to file this form is $250 a day. But the good news is they max it, right? The maximum penalty that you can incur is $150,000. $250 a day up to a max of $150,000, all for getting to file a very easy form. So if you are someone with a solo 401k, right now stop what you're doing and think to yourself, is it over 250? Have I asked my accountant if they're filing the 5,500? If they have not been, pause this, go do that. Come back and finish the show.
Because there are ways that you can work on it. I mean,
Sure.
it's in the gray zone just because they keep changing the rules on it. But there is something you can do. But once you get a notice from the government, you're in no-go territory. So
no-go.
make sure if you've heard Bo's words, you need to ask those questions. Is it over 250? Am I filing my 5,500?
So, okay, Brian, we just went through like sort of a no-no with solo 401ks. Don't forget to file the annual 5,500. We should probably talk about, okay, if I'm someone who just is an employee and have a regular 401k, what are some of the things that I should not do with my 401k? What are some of the pitfalls that I ought to avoid when it comes to participating in this retirement vehicle?
Well, this one, the first one's a big one. We get so excited. When we talk about financial order of operations, I think the biggest shocker for people is that we get you out of the ditch by covering deductibles first. But then the very next thing we usually put, and it's, look, 68% of small businesses have safe harbor plans. So that means their matching contributions are completely vested the day they happen. The second step of financial order operations is get that free money. And we're talking about your 401k match, because it doesn't matter if is it 50 cents on the dollar match or is it 100%, 100 cents on the dollar? It's a 50% or 100% match. That's 100% rate of return. You can't walk away from that.
You absolutely, I mean, if we were to say right now to you guys, hey, all you got to do is go to moneyguy.com, send us an email, and we're going to send you $20. Every single person listening to this would do that. Yet, we know through a Vanguard study that 35% of employees don't get their full match. 35% of employees out there are not taking advantage of free money. So the number one mistake that you cannot make with your 401k is not taking advantage of getting the full employer match.
The second thing I just wanted to add on big mistakes I see people make is that I see this adage that people think, I'm not going to live to be old. I'm going to live for today. I'm not going to I'm not going to take deferred gratification. I'm not going to take a little bit of today for a great big beautiful tomorrow. I'm going to make sure I max it out. So that's why you see people when they change jobs, they will take, instead of rolling that money into either the new plan or an IRA rollover, they take the money out.
Take it.
And, so that's a huge mistake we see with retirement plans. We also see loans.
Oh.
You're like, well, I'm not going to take a distribution. but I'll just borrow off of my plan.
And here's the thing, Brian, borrowing from your 401k is a genius idea because there's an imputed interest rate, but guess who gets the money? I do. So when I borrow from my 401k, I'm just paying myself interest. Well, two very important things happen there. One, you take your soldiers off of the front lines. They're no longer out there working for you. And two, it's an amortizing loan. So just because the stated interest rate is 5%, every contribution that you make back, part of it is paying the interest and part of it is paying the principal. So your rate of return is really, really low. Rate of return on those dollars is really, really low. Loans in your 401k should not be something you're doing if you can avoid it.
And I want to give something specific. We're in 2020. COVID has been a big deal, and the government such a big deal that the government has actually changed distribution rules.
Yep.
Should people take these COVID distributions?
If you can avoid it, absolutely not. Again, because your 401k is supposed to be for retirement. These are your soldiers in your army that are supposed to be working for your future self. Just because you can, just because the government says there's a special opportunity, just because some restrictions get waived, doesn't mean you should do this.
So
this
it's a
should be
last resort.
Last resort, break the glass in emergency. Do everything in your power to let those dollars keep working for you to retirement.
Because all the rules did was it waived the penalty for having early access to the money. You're still going to pay income taxes on it. So Uncle's going to get a big cut of that money. Be very careful of that. Also, here's two other big mistakes, and I'm going to give you both sides of it. It bothers me when I see young people. I'm talking about young people that have 20, 30, 40 years until they retire that are way too conservative, meaning that instead of investing in like a target index retirement fund or a total market index, they're in the cash reserves.
Yep, just have to go in the money market.
I mean, because they don't want to lose any
I'm
money.
just so scared of the market. But hey, I know I'm going to go get my free money, so I'm going to get my free money and just park it in cash inside the plan.
And then on the other side of the coin, and this is something I would have never thought, if you remember, I mean, after the .com and all the things that people have gone through, day trading is back.
It
is. If you go on Twitter and you'll see all the memes about Robinhood and all the other things, it is legit that people are back to trying to play individual stocks, day trading, and it's just people are too aggressive. You've got to have a plan for the future, and unfortunately, I think a lot of people have kind of forgotten that major step.
I even see this, Brian. A lot of folks will set their 401k allocation when they're 20 years old, and they'll do the great job of saving and putting money in their 401k, but they'll never revisit, and so they get to 45, and they still have the portfolio of a 20-year-old. You have to make sure that you are paying attention to what your account's invested in and making sure you're making decisions that match where you are. So maybe one of the things that we should talk about that's worth noting is how should we invest in the 401k? If we shouldn't be too conservative or we shouldn't be too aggressive and we shouldn't day trade, how should we think about investing in our retirement plan?
Well, and this is one I think is so powerful because a lot of people... Look, you have to love the one you're with. Not all 401ks are created equal. Right. When I go and look at the 401ks of my clients, and even as we designed the 401k for our company, Abound Wealth, we wanted the best of the best, meaning that we wanted to keep costs low. We wanted to give our employees access to super low-cost investments that had a great long-term track record. And then we wanted to make sure we gave them all the features and benefits that would allow them to have maximum growth opportunities for their future. So that's the ideal.
Yep.
Unfortunately, not all plans are created equal. I mean, it's not uncommon because by the way, on Twitter, I had somebody ask me because there's some new legislation where you're going to be able to start grouping buying employment plans as a group. Essentially, a trade group can go. This is all part of the new legislation. And somebody said, how do you think this is going to go? And my reality, here's the reality, is that you probably the big players that you want to play in this will not for a few more years. You're not going to see Fidelity, Vanguard, and Charles Schwab immediately start doing these group plans. Who usually jumps in first are the insurance companies. Insurance companies are early to adopt, but they usually have much higher expenses. Now, look, I've been shocked on some like 403Bs and other things I've dealt with. Some of these players are sharpening the pencil. I don't know if it's because of fiduciary concerns or other things like that, but it is one of those things you have to be an advocate. This is the key point. If you are somebody working for your employer and you look at your retirement plan and you go, I don't see any index funds. I feel like I'm paying a lot for what we're getting. Go talk to your employer. If you don't have Roth, if you don't have Roth accessing your plan, go talk to somebody and figure out why in the world are we structured the way we are.
And I can actually name a number of plans where someone has been listening to the show and they said, you know what, I'm going to write HR and see if I can have the index added or see if I can have a Roth option added. And we've actually heard firsthand that plans get changed. Yep. Here's another great one. If you look at your 401k lineup and there's not either some sort of age-based option or risk-based option in the plan, whether it be target retirement funds or perhaps even custom-designed model portfolios that fit a specific demographic, you should ask for that. And target date funds are maybe some of the easiest that you can add into plans right now.
Well, and I think this ties in because people, when we do shows, like, where should I go invest my money? We throw out there, so it's just part of our language when we talk to people. Before you go hire a financial advisor or do anything, go leverage the ability of a target retirement fund because these things have a lot of benefits. But let's go through a few of these key benefits.
Yeah, so the first thing, when you're starting out, we think that all you should really be focused on are answering two questions. How much do I want to save and when do I want to retire? If you can answer those two questions, a target date fund is great for you. You literally pick the date you think you're going to retire, like the year 2060. You go and buy the 2060 fund. Well, right now, while we're a number of years away from that, it's going to be more aggressive. It's going to have a higher allocation of stocks. But as you move through time, it's going to become naturally more conservative for you. So just like we said, one of the things people don't do is they don't track their allocation through time. A target date fund will do that for you automatically.
Well, it lets you focus exactly what you said on the savings habit. That's the most important thing. Don't get bogged down into where should my money go. Just get it in a target retirement fund. Focus on what you control, which is starting that awesome habit of building wealth and saving for the future.
Now, one thing that we think is interesting that was not common knowledge a number of years ago is that not all target date retirement funds are equal. There are actually actively managed target date retirement funds, and then there are indexed target date retirement funds. I'll give you a guess which one we think is best.
We do like the index variety because it drives the internal operating expenses, meaning the expenses of the portfolio to just operate and manage and what you pay. You know, you don't see a money flow out monthly or even quarterly, but it's in there. I promise you it's baked into the recipe. I like index varieties of target retirement funds because they're usually less than like 15 basis points or 0.15%. Vanguard has good ones. Fidelity Freedom Index has some good ones. So pay attention to what you have access to, and in the index varieties are much better.
And you've already said this. If your plan doesn't have it, don't be afraid to ask. It's a really easy question to write HR. Hey, can we add some target date index funds? You may just be amazed that they say, you know what? Yeah, we do. And we also were looking for a committee to form to review our investments annually. You might have just volunteered yourself for that. That's a great way to be an advocate for your army of dollar bills.
Now, I would be remiss if I didn't share that, you know, you will get to a point because everybody, we're a big advocate for these target retirement index funds, but there's going to come a time where complexity comes your way. You're going to get to where you have $300,000, $400,000, $500,000 of assets, and then you're going to start worrying about asset location. You're going to start worrying about financial planning matters, you know, retirement planning, estate planning, education planning. That's where the abundance cycle kicks in. We give you all this great free advice. So hopefully you graduate to a level of success that you will consider reaching out, taking the relationship to the next level. We would be horrible business people as well as horrible educators if we didn't tell you there wasn't a level above this. And that's actually a great time. I want to talk about strategy, Bo. How do you actually maximize 401ks and their power?
So we've already talked about how this tool is an incredible tool in your tool belt. So we think that there's sort of what I'm going to call the basic strategy to maximize that everyone ought to know about. And then there are some advanced strategies, some things that maybe you don't know as much about. But before we jump to the advanced, let's talk about some of the very basic strategy. You've already hit number one on the head. We've driven this home. Get the employer match.
Get that free money.
If you're not getting all of the free money available into your plan, that's the single biggest change you can make right now in your financial life. to really turbocharge building your army of dollar bills.
Another basic thing you can do, just make sure you're maxing out all your contributions as well as the catch-up contributions. If they're there and you have the income to support it, make sure you're taking advantage of it.
I think a great thing to do is follow the financial order of operations. Go get that free money and then go look at your... Then knock over your water. Go check your tax-free accounts you have available. Then go back to your employer accounts. There's nothing wrong with maxing out your salary deferrals.
Now, Bo, this is something I think that has happened. You're seeing more and more with the side hustles. You see people that have multiple employers.
That's right.
So if you have multiple employers, basic knowledge is you need to understand how 415 funding limits work.
That's exactly right. Across multiple plans, you can only do certain salary deferrals. You can only get one set of 19.5, or you can only get one set of 26,000, unless, small caveat, you have access to a 457 plan, then you get two. But if we're just talking about 401ks, understand how your Section 415 limits integrate and move together across different income sources, different plans. We'll talk more about that in advanced strategies.
So I just want to, if you work for a university, if you work for a hospital, you probably, or even governmental entity, perk up, because that key part about 415 limits and the integration between 401ks, 457s is a hyper savings opportunity that we'll hit on. So let's keep going. Now let's pivot into advanced strategies. This is kind of the strategies of the millionaires, the rich and famous. This is what they're taking advantage of, and you can leverage these for yourself too.
Now look, this is stuff you might not have heard of. This is stuff that you just might not be aware of. So I think the first one we ought to talk about is what we call the IRA isolation strategy.
Right.
If you have a really good 401k available to you, it may be possible for you to isolate your IRA balances inside of your 401k and take advantage of a Roth conversion. Remember, a Roth conversion is when you convert pre-tax assets into Roth assets. Well, there are two ways you can do that. You can do it the taxable way, or you can do it the tax-free way. We actually like the tax-free way. Surprise, surprise. So if you are thinking about, can I do a Roth conversion, we have a little flow chart for you. All right, so if you start here, first question to ask is, am I over the income limit? Here's what you do. Google income limit for contributing to a Roth. If the answer is no, I'm not over it, just contribute straight to a Roth IRA.
Much easier just to contribute to the Roth IRA standard.
If the answer is yes, then you have to ask yourself, do I have any other IRA assets? Now, this doesn't include Roth assets, doesn't include inherited IRAs.
But it does include like SEP IRAs, simple IRAs. I mean, rollover IRAs, traditional. You're going to have, because you hear people about, I saw it on Twitter last night, somebody was asking a question about the prorating of basis on IRAs, and I was like, oh man, they need to know a little bit about this isolation strategy.
So if the answer is yes, you cannot do a tax-free Roth conversion under your current structure. What you might need to do is take those IRAs, and assuming you have a really good 401k with really low-cost investment options, with really diverse investment options, it might make sense for you to roll that traditional, that SEP, that simple, that IRA rollover into your 401k.
All the pre-tax assets.
All the pre-tax assets to zero that out, because if you can get it to where the answer is no, I don't have any other IRA assets, then you can do what's affectionately known as the backdoor Roth conversion or Roth conversion strategy, where you can contribute to a non-deductible traditional IRA. You don't take the deduction, you convert it to Roth, and because the assets are all after tax, it's a completely tax-free conversion. Why is this a 401k planning strategy? Because the 401k is the thing that allows you to zero out those pre-tax IRAs. But you have to make sure you have a good 401k to do that.
Yeah, so that's what, if you are sitting on those SEP IRAs, the simple IRAs, because look, I've had them all.
Yep.
Well, if you think about my first company, you don't start off, back then they didn't even have solo 401ks. Right. So you always started with a SEP IRA, then you graduated to a simple IRA, and then you started doing 401ks. A lot of you guys are probably the same way. You can roll those old IRA assets back up into a great 401k and set yourself up for some of these advanced planning strategies.
So that's advanced strategy number one. Advanced strategy number two, this is a big one. And this is one that we alluded to earlier. It's the mega Roth conversion or the mega backdoor Roth that's only available inside of specific 401k plans with specific provisions.
Yeah, and what's interesting is that we've spoke to a few corporations.
Yep.
We get to go in, talk to executives and others, and we see this on really good plan designs. You will see a lot of the plans will offer after-tax contributions. They'll allow in-service either distributions or in-service conversions right there within the plan. That's all the magical recipes you need because that allows you to, as Bo talked about earlier, we can load up the $57,000 that you can put into these qualified plans, $63,500 if you're 50 or older, and then any area that you have that's not crowded out by employer match, employer profit sharing, you can go above the salary deferrals with after-tax contributions and immediately turn them into Roth funded contributions through a conversion.
So I'm going to give you an example. Brian, check my math because math is not my jam when I'm doing it on the fly. Let's assume that you max out your salary deferrals at $19,500. Right. And let's assume your matching contribution your employer puts in is $10,500.
Okay.
That takes us to a total of $30,000. My math right? If your plan allows for after-tax 401k contributions, you could elect to put another $27,000 into your 401k of after-tax contributions. If you stop there, the $27,000 goes in after tax, and any of the earnings will grow tax deferred, and when you pull the money out, the earnings would be taxable. Unless you have access to number two. Your employer allows you to, in that same year, roll those after-tax contributions to a Roth or do an in-plan Roth rollover. Once you do that, that $27,000 of after-tax contribution turns into $27,000 of Roth that then all of the earnings, all of the growth will be tax-free forever. If you think it's really cool to be able to do a $6,000 Roth IRA contribution, or you think it's really, really cool to be able to do a $19,500 Roth 401k salary deferral, then you should think it's really, really, really cool to be able to do a $27,000 mega backdoor Roth contribution.
I do want to kind of put some, because I've had some questions on this, and I know we're way in the weeds, but this is, the people who are hanging out now are the financial mutants, so they'll appreciate this additional depth. If you're a business owner and you know that you're either fully funding the $57,000 or the $63,500 if you're 50 or older, this might not be as exciting to you, especially if you have employees, because if you know you're already fully funding that, you have to worry about the testing issues. Plus, it's also, if you're in a higher tax bracket situation, do you want to go ahead and pay at that highest tax bracket just so you can do a mega Roth opportunity? So it's not as great for those people. This is really awesome for executive level employees, that this additional after tax is actually more money you're saving. It's more savings is what this enables, is why you get so excited about it. And then that more savings is actually tax-free Roth eligible. That's the part, that's the secret sauce that gets people excited. It is somewhat complex, and I have to clarify that because there's a lot of my small business owners out there who just salivate at the idea of having all this Roth money, that I always have to say, yes, but there's some catches to it. You have to check some boxes. You have to go run some census data, really nerdy stuff to make sure this is a good idea. So let's transition to another strategy. Bo, we call this multi-income source hacking.
Yeah, so one of the things that's really interesting, we already acknowledged that when you have 401ks, you only get one 19.5 or you only get one 26,000, no matter how many 401ks you have. However, that $57,000 limit that can go into 401ks is per unique employer plan. So if you're someone, perhaps you're a doctor and you work for a medical group, and then you get income from a hospital, and then you have a book deal, you have different income sources coming your way from different employers that are unrelated. One of the things you can do is via solo 401ks, if you have access, you might be able to max out one plan at $57,000 and then have another plan where you're also taking advantage of either profit sharing contributions or possibly even after-tax 401k contributions. That $57,000 can go across multiple different plans.
Remember, here's the key parts of this. Contributions that go in these retirement plans are coming from two sources: employees, employers. We know the employee money, that's your 415 limits, your salary deferrals. It's capped out. It doesn't matter how many employees, and companies you work for, and companies you own. You only get one 19,500. Now there is one hack on this: 457s. You get to do both. You can do 401ks and 457s, different code section with the IRS. But here's the thing: I want to make sure I bring everybody back with these multi-income source hacking is that it's the employer portion that's enabling this, is because that profit sharing, that 20 to 25% of the income sources is what can fill up that second bucket of $57,000. So you've got a lot of income. This is for somebody who owns very successful businesses, very successful income sources, so that they can hyper accumulate and build this type of thing. But it does work. Now, there is one word of caution: control groups, guys.
Oh, that's a big one.
Because here's what the government's always worried about with retirement plans. They don't want you to have some cruddy plan over here for your employees, and then you set up some really Cadillac loaded up plan just for yourself or your executives, so you're to the detriment of these people. They always want to. That's why they have all these control group rules, that if you have common ownership, and you can have a parent subsidiary where it's a mega company that owns 80% of this smaller company, you're going to run afoul of things because of the common ownership. You might have a brother-sister control group where you have 4 or 5 individuals that own multiple companies with some common ownership between the two of them. That is going to make you run afoul of this too. The biggest thing you can do is if you have, and I'll give an example, you can own a company and you have income coming in, but then you have this other thing out here that has no affiliation to this other company, and you don't have any ownership with the way you get paid. Maybe you're 1099 from this organization. You can then load up that profit sharing, and that's what's going to allow you to kind of have multiple source income that loads up these qualified retirement plans. It's really powerful stuff.
It's powerful stuff. If you're a high income earner and you have multiple sources of income, once again, the 401k can be a valuable tool in your tool belt, but it gets complicated. This is one of those areas where we talk about maybe it makes sense to know when to go pro, to graduate to the next level. Before you start trying to figure out some of these strategies, it probably does make sense to reach out to a professional.
And think about it. We didn't even talk about it in great detail, but another one, it's like cash balance plans.
Huge.
These are additional plans. They're not 401ks, but you strap them on top, as another qualified plan that you build into. Yep. And what I think is interesting, this kind of is the Seinfeld full circle. We know 401ks are defined contribution plans, but I do think if you're in a very successful high income situation, you do bring back some of those components from a defined benefit. That's like a cash balance. So you can really turbocharge the savings, but also provide a benefit to some of the employees. It's a win-win all the way around.
Now, Brian, at this point of the show, I was like, all right, good. End. We're going to say, hey, go subscribe, go do this. We're done. Awesome. But you're like, no. We can't stop there.
I asked FTE Daniel, and I guess you could call this is kind of the touchdown dance, because I had Daniel. I said, Daniel, give me that slide one more time. If y'all remember, we did a show, and this is kind of what led to us doing this, is that Bloomberg posted this just ridiculous. It was a headline grabber. It was clickbait. I don't like this type of stuff because the whole reason this was written was to get attention, get more clicks, and guess what? It was extremely successful. But the title was 401k plans no longer make much sense for savers. Bo, I think that we have answered the question on this, is that if you're not maximizing this, if you can't see the benefit, and by the way, if you want to see this whole argument destroyed, go watch the start of our Q&A show, because we actually do a deeper dive on this. But I do think by going even deeper into the planning strategies, all the different components of 401ks, we've hopefully showed you how you can harness the power of this very powerful tool that's going to help you build financial independence.
If you haven't had a chance yet to go check out our website, go to moneyguy.com/resources. Out there, we have PDFs available for you. We have resources. We have spreadsheets. If you've not done that, do that. If you have not had a chance to go check out the Money Guy Financial Order of Operations course, you're going to want to work through this because we really do believe that it can and it will change your financial life by letting you know exactly what to do with every soldier in your army of dollar bills.
Well, think about it. Please excuse my dear Aunt Sally has insured for a generation, multiple generations, that we're doing math correctly. We know finance is a big part of math. Why wouldn't it work for your money to have a financial order of operations as well? We've essentially created the instruction manual for you to make sure you're maximizing and creating as much opportunity out of your money so that you're working as little in the future with your back, brains, and hands. You're letting your army of dollar bills do all the heavy lifting. So go check it out. Thank you for all the support. We've been doing this since 2006. I can't believe how this journey has taken us to where we've fine-tuned the message. We've created a group of people, a family that support us, and now we're going to create things that are going to accelerate the wealth creation. That gets me excited.
Let's just stare at each other for a second.
Talk about awkwardness. Money Guy team, out.